June's headline, Consumer Prices, posted the biggest decline in more than 6 years, and this provided some temporary relief for inflation numbers. For month-on-month, it dropped to 0.4%, bringing the year-on-year number to 3.5%. For core consumer prices, it didn't change on the month. The year-on-year number is 2.6%. And since core inflation removes energy and food prices, we then look at services costs, which moderated significantly. Shelter prices increased 0.1% on the month. Transportation dropped 0.3%. These figures are good because of the short pause in the disruptions at Strait of Hormuz, but the war recently renewed again. So for the time being, the latest data shows that energy index dropped 5.7%, but year-on-year it's still a 15.7% jump. The report showed some relief in inflation, and stock market futures were mostly positive. But the drop in inflation could be short-lived because of the renewed issues between U.S. and Iran, and it's very uncertain to know what's next. So then, traders still continue to expect Fed to hike interest rate in September at a 62% chance. On to Eurozone's industrial production. The trend is still sluggish with no clear direction, but fortunately the Middle East war didn't cause a large decline. Eurozone May's industry production declined 0.2% month-on-month, but it's still above when the Middle East war started in February. The trend is at the chart on the right. Breaking down into the countries in Eurozone, it's been mixed bag. There are sharp declines in Ireland, some drops in Italy and France, but gains in Germany and Spain. There's no clear trend now. Industrial production in Eurozone matters because it contributes a quarter to Eurozone's GDP. Look at the table on the right. That's the latest data available from OECD's 2025 survey. So, despite the small recent decline in industrial production, the production still held up okay because much like China, foreign businesses are importing from China, increasing inventories to counter the possible supply chain disturbance from Middle East war. Next, the biggest reason that supports Eurozone's industrial production is the structural increase in defense spending in the entire Eurozone. Eurozone defense spending will experience a surge with a total EU defense expenditure to hit about $454 billion. That's a 8.6% year-on-year jump and a 75% increase from 5 years ago. What's next is everyone's hoping for more stability in geopolitical sense and lower energy prices. So as a whole, it's still very unclear in Eurozone area, but because of the structural increase in defense, this provides a boost for European defense-related industries. Recently, South Korea's central bank hiked interest rate by 0.25%, lending at 2.75%. This is to control the high inflation and to support the currency, Korean won. The key summary is because South Korea's economy is relatively strong, which includes growth and inflation getting higher too. So, the central bank has more room to raise rates without immediately pushing the economy downwards. And some background is, South Korea's economy is recovering faster than expected, as supported by strong semiconductor exports like we covered last week, Samsung, SK Hynix, and AI-related investments. The central bank expects South Korea's economic growth to exceed its 2.6% forecast. But the problem is, consumer inflation exceeded 3% in May and June. You see the trend at the chart on the right. May was 3.1%, June was 3.2% year-on-year. And also, a weak won makes imported energy, food, and raw materials more expensive. Bringing more imported inflation, pushing the interest rate upwards will combat the high inflation and the weak currency. Let's touch on impact on equities first. This is Bank of Korea's first interest rate hike in more than 3 years. This will add another headwind to the already fragile Korean stock market, the Kospi index. Look at the trend on the right. Recently, mostly because of overcrowding and investor profit-taking in AI-related Korean equities, the index suffered a drop. The interest rate hike is significant to Kospi because the Korean stock market index is heavily dependent on highly valued and increasingly leveraged positions in Samsung Electronics and SK Hynix. But the Korean market decline is not mainly caused by the rate hike. Like what I said earlier, it's overcrowded and mostly profit-taking. For the impact on currency and bonds, higher interest rates will support the currency. It'll also make won-denominated deposits and bonds more attractive. Lastly, higher interest rates will reduce companies' valuations. Certainly because when you bring the forecasted earnings to present day, they'll be discounted at a higher discount rate. And more importantly, financing costs will increase in terms of loans, bonds, and debts from. This will also affect the AI capital expenditure burden. So next, the Korean stock market index now faces a bit of a difficult combination: higher interest rates and also declining risk appetite towards semiconductor companies. But this doesn't mean that the global demand for memory chips is directly and immediately removed. It's not. The demand is still high, and the good thing is, Samsung and SK Hynix both earn much of their revenue from international customers. On to the Middle East war. Oil prices rose sharply because of renewed fighting between U.S. and Iran. There's again the risk of prolonged supply disruptions at Strait of Hormuz. Brent crude, the global benchmark, climbed 3% to $90 per barrel, and then WTI is slightly below at 85. Brent already surged to nearly 16% during the previous week. Some background is U.S. continued airstrikes against Iran for 9 consecutive nights and enforced naval blockade again on Iranian ports, and then Iran is targeting vessels that said have violated its navigation restrictions. The immediate impact is it'll be negative for airlines, transportations, chemicals, manufacturing, and consumer-related businesses because of the higher input costs. But however, for broader equity markets, it's mostly restrained. U.S. stock futures were broadly flat. You see the chart on the right? Investors are now balancing between the oil shock against the upcoming corporate profits optimism. So next is obviously the markets are concerned about higher inflation again and whether central banks will keep interest rates high. So, trying to link today's topic to the market. Again, this isn't a buying guide. This is meant to see how global market trends affect different industries. We covered that in Eurozone, there will be structural increase in defense spending by the respective governments. Defense-related companies will tend to benefit. Next, for South Korea Semiconductor, investors focus on AI memory demand. Global demand is high, semiconductor-related stocks will benefit. Then, Goldman Sachs's gain is mainly earnings-driven. And lastly, shipping container and logistics companies. Because the global demand, bigger companies will experience some form of gains in equity prices. Markets price in the rerouting bottlenecks and more expensive maritime logistics.